Hi guys, welcome to Bukas Masterclass. And if you're joining me for the first time, this is Bukas Masterclass, and what we do here is crypto tutorials and tradings, and we have come again with another tutorial today, which is risk management. And this risk management, we are going to discuss about the full concept of risk management. So if you are joining me for the first time, the first thing you need to do right now is to like this video and subscribe to the channel, and you have the right to watch the video to the end right now. So guys, welcome back to that short break, and let's get started with the full course we have today, which is risk management. So as a trader, you are entitled to these things below as your trade output. So what does this mean is, if you are trading, and anybody that places a trade, you are expected to get one of these 5 things as the output of that trade. Number one is big profit. Number 2 is small profit. Number 3 is break even, no loss, no profit. Number 3 is small loss. Number 5 is huge loss. So if you are a trader, you are expected to get these 5 as your output in any trade that you open today. I hope I'm not confusing you. Now, the purpose of this course is for you to avoid the last one, which is huge loss. And the benefit of this course is for you to be in the category of the first 4. So after watching this video to the end, you are going to be able to stay in the category of the first 4 in the listed points above, which is big profit, small profit, break even, or small loss. That's the person you are going to become after watching this video. So let's dive. The concept of risk management, risk to reward ratio. As a trader, to avoid huge loss, you need to understand the concept of RR. That's it. In order to avoid huge loss, you need to understand the concept of RR as a trader. So if you don't understand the type of risk to reward ratio that you will be using, you are going to make serious mistake. But when you understand how much you can risk per trade and how much you're expected to make per trade, this will help you so well as a trader. So for example, if I am to trade 1:20, what does 1:20 mean for you? If you are hearing this for the first time, what does 1:20 mean? So this means that I am risking $1 in the trade ratio. I am expecting to make $20 profit in that same trade. Guys, 1:20, which is 1 times 20 equals to $20. That is, if the trade goes in my favor, I will make $20 profit. But if the trade goes against me, for instance, if I analyze that BTC should be going up in this ratio, and after my analysis and BTC started coming down, that means I am going to only lose $1 because I risk only $1 in that trade setup. The next thing is how to determine what to risk in a trade. That's what I mean there. How to determine what to risk on a trade. To do this, you need to follow risk management rules. There are several risk management rules that we have. One is never risk more than 2% of your portfolio on a trade. That is why some people, if you ask me that you are trading with $10 and you are opening trade, you are trading futures, and they are only trading with $10, you only have $10 in your portfolio. Do you know that if you are trading it on MaskEX, you are risking all that $10 in your portfolio, because you cannot open any trade less than $10. You know that. So it is not advisable. Rather, you have to build the money a little bit for that. The amount of money you have for it to sustain you if you are acquiring any loss in that trade. That's number one. Then, for example, I have here is, if you have a 1,000 trading capitals in your trade, in your portfolio, you are expected to risk just 2% of 1,000, which is 20. I think I make sense, right? So 2% of your portfolio, that's what you are expected to risk. Then, using RR, that is 1:10, on a positive side of this trade, you will profit $200, and on the negative side of this trade, you are only going to lose $20, because you are risking 2%. Then what happens is, this place you will have $20 here. You have, because this is how it is now. For example, this is how it is. It will now be 20:10. You understand? What are you doing here? You are actually risking you are risking what? You are risking $20 in order to make 10. Okay, 10 ratio and above. So what does it mean? You're going to times 20 times 10. I think when you times this in, you're going to get 200. That's 200. If this trade setup go in your favor, you are going to end up making 200 from that trade, and adding it up to your capital, you have 1,200. Hope I'm making sense. So that's it. The second rule that we have is, rule number 2 is knowing what a good risk to reward ratio is and taking only such trade anytime, any day. Now, you as a trader, you have to determine the best risk to reward ratio that you will be using. Is either you are risking 1 to make 2, or you are risking 2 to make 3. So now here below I have one of the best setups that I'll be using, and one is 1:3, 1:5, and 1:8. These are good RR setups, so you can also research on your own to know the best that suits you, but this particular tree is what I use: 1:3, 1:5. Most of your mentors will tell you to use all these 1:3 and 1:5, but actually you can be using 1:8. 1:8 is to the extreme. That depends on how you attempts to make profit from that, and how much target of profit you are looking at. So for example, if I use 1:8 as my risk to reward ratio, and I am risking $20, so what I'm expecting to make from here is 20 times 8. So 20 times 8, so I'm expecting to make this amount. So if you times 20 times 8, that's going to be my output from this trade. And if I am using 1:3 and I am risking $20 out of my trade, so what I'm going to make is 20 times 3. I'm going to make 60. You understand this setup? So I'm going to be making 60 as my output from this trade. The same thing goes with 1:5. If I am risking $20 from this trade, you're going to times it by 2 times 20 times 5. So 20 times 5 is going to be the output of this trade, which will be around $100. So that's it. So second rules on risk management is knowing what a good risk to reward ratio is and taking only such trade anytime, any day. Then there are I will do that later. And there are one thing about this one here is, for example, some people don't know how to set this thing up. and it's actually very easy to set up, because we have the long and the short in our trading view. Trading view is one thing that helps us to determine this. So we have the long and the short, and anytime you place this long and short, there is one thing that it does. It actually shows you your risk to reward ratio. So it actually tells you the risk to reward ratio. Hope you can see that. And so if you are seeing my screen right here, you can see this. There is a risk to reward ratio here, which is 1:2. You can see that risk/reward ratio. So if I am taking this trade setup, I am going to make, if this trade should go in my favor, I am going to make, if I'm risking $20, that's 20 times 8. I'm going to make this into suit to my budget, which is this is 21:8. So if I'm going on this trade, I am only going to risk 1% to make 8%. That is, I use $20 is 20 times 8. That's it. So this is how to calculate it on trading view. On the opposite side of it, we have the short positions. So the short position are also the same thing. You can place the short position like this, and you will see your risk reward ratio here. This is where to calculate it. As you adjust it, that will suit the risk reward ratio that you have selected for yourself, and the one that you have choose that you will be using. So that's it. So let's go ahead now. This rule number 3, knowing when to break even or leave the market. As I do say this thing is very, very simple, and it's very, very simple word. As I do say, when your reason for entering a trade is no longer there, then you need to leave the trade. For example, let's go to trading view and let's make some experiment. For example, here, let's say that I want to short this market. And why do I want to short this market? I want to short this market because I have seen that it is on resistant level. Okay, it is on resistant level. I want to short this market because it is on resistant level. Now, you know that the reason for me to short this market, because I have seen that it has hit resistance level. So let's say in a couple of minutes this resistance level got broken, and the market started going up, started pumping up to this level again, to this above it. There is no need for me to keep holding this trade and also expecting miracle to happen. You know why? Because the reason why I entered the trade is no longer there. I entered the trade because I saw it on a resistant level, and technically when a trade hits the resistant level, it has to drop. So, but then it might be fundamentally that this thing has been pumping because there are some certain things, like partnership or something else that happened. So it didn't drop from resistant level. The resistant level got broken. We now have some upper highs. I need to leave the trade, even though I know I did the right thing by entering at the resistant level. But then the resistant level has got broken because of some other external stuff which is not technically. So I got to leave the trade. That's what I mean by this. That's my point when I say, as I do say, when your reason for entering a trade is no longer there, then you have to leave the trade. When you have a reason for entering a trade and is no longer there, you leave the trade. The same thing goes when you see a support level. The same thing goes when you see a candlestick pattern. The same thing goes when you see an order block. The same thing goes when you see a supply and demand level. So all these things are the same, and when your reason for going there is no longer there, then you have to leave the trade. The next thing we have talked about in this particular course is how to calculate R ratio. And TradingView long and short position tools has inbuilt calculator where you can calculate your R to reward ratio, and you could also calculate it manually by dividing your profit percent by your stop loss percent. So when you divide your stop profit percent, when your profit, you divide with profit percent by SL percent, that is stop loss percent, you got your risk reward ratio. I hope I'm clear. So this is all we have for today's tutorial video, and if you do like what you have learned here, do well and subscribe to the channel, invite your friends and share the video. So if you have any question relating to this particular video, you can drop your comment below, and I'll also be going through all the comment section. We'll have a community where we trade, where we do everything. You can also join the community. I'll also leave a link below the description of this video where you can join the community. We'll have many things happening in the community. I do analyze trades in the community, and I set all the signals. You can be trading there and be making money for yourself. And if you also here and you have not registered on the MaskEX exchange, there is also one thing that's left for you, because this is one of the most top exchange right now, and that's why I trade for it. And if you like to gain some signals from me, then you have to register on this exchange, because I only respond to those who has this exchange. If you don't have it, then I will not respond to you. But if you have it, you are welcome to my DM anytime, any day, and I will be ready to assist you in all your trading requirements. So all you have to do is, I'm going to leave a link in the description of this video. You can use the link and register. Follow me on Twitter, Facebook. I'm only active on Twitter and Facebook, these two, and also on Telegram. But if you're following me on Twitter, we're having Twitter space anytime, any day. You can also engage on our Twitter space and also learn many things from there. So thank you for watching. Do have a lovely night.